India's hospitality sector is having its moment. Hotel signings are at a record high, occupancies are strong, capital is circling the sector with a renewed appetite, and yet, building and owning a hotel in India today has never been more complex. This session asks the question every owner in this room is quietly carrying. Is now the right time to build, buy, or hold? We have assembled three of the sharpest capital minds in Indian hospitality for this panel today. Please welcome Mr. Shobhit Agarwal, MD and CEO of ANAROCK Capital, in conversation with Mr. Ashank Kothari, MD, Brookfield Asset Management. As you know, Brookfield is amongst the world's largest equity firm and in India owns the Leela Hotel Group. Also in conversation is the executive chairman of Lemon Tree Hotels, Mr. Patu Keswani, a celebrated hotelier, having built India's very own homegrown $1 billion Lemon Tree Hotel Group.
Hi, good morning, everyone. We are going to use the old traditional mics. I think we started the morning really well, speaking to the tourism minister, then followed by real estate. Then we are coming back to our favorite subject, hospitality. And there are many, many owners who are sitting here. And we have two really big owners. Our legendary Patu Keswani doesn't need an intro, and Ashank on my extreme right. He was the first private equity to have bought controlling stake in a hotel, literally 100%, in 2015 when they acquired, 2019 when they acquired the Leela hotels, and then they've obviously listed it now. So we'll talk about what their experience have been. I think today's we're going to cover three things. Capital, which I think this morning was addressed as one of the hands in participation of the PPP model, the consumption pattern, and of course the confidence on what's going on. So let's start with the subject I know best, which is capital. Hospitality sector typically has a long gestation, recovery, uh, low ROIs. It is hard to build, hard to operate, hard to manage, and is also subjected to cyclical sort of performance, some good years, some bad years. And then eventually, when you're trying to make money, time comes to make money, your hotel is ready for refurbishment, so it needs money all over again. So you need a reset. So it's really a very, very hard asset in that sense to continue as compared to some of the other assets in the similar asset class. I won't call it same, but let's compare it to office, where you build the office and rents keep coming to you. It's quite easy. You don't have to worry about seasons, foreign on domestic travelers coming in. But what it means for all of you who are trying to build or own these hotels is it's really dependent on two things. One is cost of capital, and how favored that is from private equity. And we haven't seen too much of it, except these two gentlemen who managed to get some private capital before they went public. And let's talk about that experience. And second is how do you beat the cycle to make sure that what you built is in which eventually good for the shareholder. Of course, the consumer is very important, but how does shareholder make some meaningful return in this? And let me start by Ashank. Ashank, there is a divide between asset ownership and what's more now gaining popularity is asset light models. So where does the capital go? Do you prefer to put it in the asset light platforms, or do you prefer to put it in this? And what should the industry do to bring down their cost of capital? One of the ask is give it as an industry status, but but I'll leave it to you, and then I'll bring in Patu as well. Same question to you, Patu.
Uh, Maybe I'll reframe this a little bit. I think we can all agree in this room that expensive capital has actually been one of the positive things in terms of keeping supply constrained in the last decade or so, which in a way has kept the demand supply gap that is creating a lot of money in this room right now. So in a way, I would say that having expensive capital has allowed, in the previous cycles, you saw a lot of hotels being built, where in cities where hotels were not needed, or the sizes of the hotels were significantly larger than what made economic sense. And in the last decade and a half, I would say, that has rationalized quite a bit, which has led to very positive demand supply fundamentals, leading to higher ARRs, higher occupancies. But you're right, the cost of capital is high. And I was actually joking with Anurag earlier today. I think Dr. Krishna said something uh, in his earlier conversation that he's trying to create predictability. And when I look at it from a capital standpoint, the two things that matter for cost of capital is liquidity and predictability. So today we don't have a very strong secondary market. It's easy to check into a hotel. It's very hard to check out. We don't have a very strong secondary market. We don't have a REIT market for hotels. You have a handful of public companies, including Lemon Tree, Leela, Chalet, Brigade, and a few others that are willing to buy assets and are willing to invest in the real estate side of the equation. But that's not enough. So when I'm writing a check for buying an asset, I'm constantly thinking, what is my whole period going to be here? And is it going to be longer than I want it to be? So that has a liquidity premium associated with it, or an illiquidity premium that gets associated with it. And I'll say that from a perspective of predictability, right? The cost of capital is associated with having predictable cash flows. So the more predictable you make it, the lower your cost of capital goes. But let's admit it in this room that we like keeping things very exciting in Indian hospitality, and that results in difficulty for us to be able to underwrite with certainty. Every time I talk to an asset owner, they will talk about the best quarter they've had, the highest ADR they've had, the highest occupancy they've had. But you don't pick a cricketer in a selection team, right, on the basis of the last century they've hit. You generally pick it on the basis of the average that they have in their career. So we need to understand how do we operate these assets through cycles and create that track record through cycles to bring the cost of capital down. If that answers the
It's a
question.
long drawn question, but basically you have to, in many ways, pray and pray that your customers keep coming and there is something that's going on. Otherwise, let's have more AI conferences
Look,
everywhere else.
I
Maybe
think
they'll
cost of
keep the
capital will stay high for some time as long as we keep things exciting. But would love to hear.
And I'm going to distinguish this because I know
Yeah.
this gentleman has just listed things. But is it because the cost of private capital is very high that all of you are gravitating towards public equity raise? And there's been a spur of that pipe starting with you guys and then Park Hotels, and there are so many companies that got listed. But you've just sort of done Propco, Opco. So what is going on here? Is it you're trying to bring down cost of capital, or are you trying to solve for something else, which probably we haven't really noticed?
You know, I agree with Ashank from his perspective, but from my perspective, it is a little different. I don't look at cost of capital. I look at risk, actually, personally. And from risk, I price capital. Okay. Which means that if it's risk free, I get a much lower rate. If it is high risk, I get a much higher rate if I'm accessing capital in whatever form. So the kind of capital I look at is there's equity capital, which is fundamentally infinite, or it's like a perpetual fund. Then there is capital of a finite time. I think what people tend to forget is that capital has a different capital structures which have different lives
Life.
are priced because of that risk of that time period. So I'll give you an interesting example. If I get capital from a pension fund, okay, they are patient capital. They are closest to equity capital. In fact, if they either put in equity or it's a structured credit deal, they will think 15 years. I get private equity capital. That person or sovereigns will think 15 years. Private equity capital will think 6, 5, 7 years.
That's right.
Okay, so bank capital, depending on, or because bank debt is capital in a form. You know, how long are they lending it to you? How are they aligning your cash flows, so on and so forth. So each of these, because of the finite value of that capital or finite duration of that capital, is priced differently. So suppose I was saying, I want to build a hotel. How do I strategically get the right capital? Here's what I learned. I used to get 12% capital when I started, and I'm talking now debt. Then it became 10, then it became 9. One day I sat and started, thinking, how do I get the cheapest debt capital in India? And it was so simple that I urge all of you to do the same. I said, I will never finance a hotel till it's ready. Firstly, I will take no risk till the time the hotel opens, because that's where the first mismatch of moratorium and repayment of principal and all that bullshit starts. So I will take no debt. Therefore, 100% of this hotel will be built with equity. You need to have balls to say that. Okay, I said that to Warburg, who was my investor back there in 2006, and they cried. They said, look, your cost of debt is 10%. That means my equity return is 10%. I said, that's not the way to look at it. Look at how it'll play out. And by the way, later Warburg told me, now they've come back, that they made it mandatory for many of their businesses to follow this methodology. So what I did is I said, okay, here's a hotel that costs 200 crores. I would borrow 100 crores. Screw that. I'll keep 100 crores of equity as quasi debt, build this hotel, open this hotel, and then I'll take the debt. That brought down by 200 bips my cost of capital. Then I said, Rahul was there in those days. Then I said, screw that. I'll take debt funded by my previous hotel. That is the domino effect. So I build one hotel, it's stable, it's earning, it's got a DSCR, which is very sexy. The next hotel which I build, firstly, I will over-equitize and open it. Then I will take the debt on that hotel on the cash flow of this hotel. So what's my cost of debt today? 6.9%. That's what I borrow at today. And I borrow it for 15 to 18 years. I don't need infrastructure status. I joke about this with Puneet and all these guys. I get 3 years moratorium. Next 4 years or 5 years, I get to pay back 15% of my capital. The next 4 or 5 years, I pay back another 20% of my capital. After 11 to 13 years, I start paying back 60% of my capital. Now depreciate that by 4% and take into account that a hotel asset appreciates every year by a minimum of 5 to 9% without land. Land can go where it can. This is a winning game. You cannot lose, especially if you think 15 years out. So that's the fundamental point I'm making. I need to access short-term capital, but at very cheap price, so that the long-term capital, which is my investment, grows at some insane rate. So you ain't seen nothing yet. We are the youngest company. Most of my assets are 7 years old, 6 years old. But I think the next 7 years will be an interesting runway, especially when people like Ashank and many of you who are rational investors and don't drop prices unnecessarily are in the market. I think now you will have some predictability. So that's the long answer to your short question.
I know Ashank is ready to respond, but guys, this is immensely valuable. What he's really saying is his own story on how this is built, how he's managed his capital stack. Before I let Ashank react to it, I have one question. What's the rationale between OPCO and PropCo? What are you really trying to solve? Why did you split the two?
So when I started, I started with 3 crores, of which I think 1.5 was mine, 1.5 was some friends. Built one hotel. Had to call Deepak Parekh. Nobody was lending me money to take a loan. Then the hotel did well. We did a second, third, fourth, etc. And then Warburg came. Warburg said, your company is worth 800 crores. I said, wow. I actually didn't do the pricing, I had no idea. So this is serendipitous. I raised that money, 300 crores from August, deployed it. Then APG came, so on and so forth. So I think what I realized is at different times, I had different investors slash capital providers with different expectations on compounding and so on. Like I love Warren Buffett. He talks this language that if you let compounding work for you, even average investments in a decent company that lasts for 40 years, you know, an average compounding for a longer period.
It's the eighth wonder of the world. Compounding
But I
is
like the guy, yeah. So anyway, so when I ran short of capital in APG, said I'll give you 2,000 crores. So I mean, that's the kind of money they deployed in Fleur. I don't have money. I've got the total capital was, I think, 20, it was 30, 40 crores of, me and my friends, 270 crores of Warburg, and I think retained earnings of 200 crores. We had 600 crores. These guys want to put 2,000 crores, but I want 60%. So what do? I had built hotels. So every hotel I built, I said, you price it. And they, because they were pension funds, priced it on a yield. So I gave my stable assets. I never gave a new asset. I gave stable assets. And every time I did it, and in those days I used to leverage 1:1 systemically, I found I was selling it at 3.5. So basically my equity was growing 6x. Okay. So here it is, I've spent 100 crores. I'm selling it for 600 crores. And every time I put 600, they would put in 400. So my 100 crores was giving me 60% of their, and their 400 was giving them 40. So what I realized is development capability, which developers have by definition, overlaid with hotel ratios, which unfortunately no developer has, with due respect, gives a 58% EBITDA margin, which is my margin, by the way. Okay. So why shouldn't I monetize it? So let me build hotels. Let me put it in an asset co. Let me list the asset co. The kind of, right today, some hotels I own, some are in the joint venture, some are leased. So let me put it all together in one platform. Next year, it's got 1,000 crore EBITDA. What will it be valued at? Today, it's all hidden in my company. And by the way, a lot of investors still don't understand it. But I get 200 crores of management fees from there. That's worth 35 times. Think of it very simply, yeah. Asset into asset EBITDA is, say, 20x. I'm just taking a number, okay? 15x. Management fee is 30x. It's 2x. So think of it this way. I put 1,000 crore EBITDA into a company and I list it. Let me assume it lists at 15,000 crores. I'm just taking numbers. I own 40% of it. I give 30% to Lemon Tree shareholders, of which the largest shareholder is me. I make a lot of money. Now, this company does a QIP and raises 1%, which means on 15,000 crores, it raises 1%, is 150 crores. I borrow 150 crores. That's 300 crores. I build one hotel. My stable return today is about 16%. So I make 300 crores. I make 45 crores return. Revenue is about 100 crores. My fees are 3.3 crores. 3.3 into 30 is how much? 100. So every time Fleur dilutes 1%, I make 100 crores in market cap. I can dilute thousands of crores. I'm going to go all out, man. I'm going to be another asset co. There are enough of them, I'm sure, in this room. I want to participate in that. I want to build fee income, and I want to go wherever Indians go. That's the strategy in 4 lines.
Excellent. I'm not sure whether Ashank, you're convinced. Are you going to split your Leela Ventures into asset co or management co? On this rationale.
No, look, it's a great rationale, right? And I completely agree with what Patu is doing from a Lemon Tree standpoint, right? We get asked this question a lot: asset light or asset heavy. Anurag says asset right. It's like asking, should India bat first or bowl first? It depends on the pitch. It depends on the conditions. It depends on आपके bowler अच्छे, आपके batsman अच्छे, right? It depends on a lot of things, right? Asset light has its own merits to it, which, the problem it solves is velocity. As Patu's explained, that, he can do multiple management contracts, scale up the brand massively, get a much higher multiple. And I think that math really works well from from where he's sitting for his company. What I think the asset light playbook misses to some extent in certain segments of hospitality, like luxury, for example, is that, to Patu's point, the compounding effect that you can have in real estate is massive. Today, it takes 7 to 10 years for a luxury trophy asset kind of a hotel. From the time you are acquiring land to getting permissions to constructing, conceptualizing, opening, stabilizing, it's 7 से 10 साल lag jate, right? Barriers to entry are pretty high, right? You can't recreate a Leela Palace New Delhi. You can't recreate a Taj Mahal Palace Colaba, right? I mean, those are very hard assets to replicate today based on math. So when you're able to acquire these assets, uh, the demand pie is growing massively, while the supply is not really increasing in those trophy assets. So the ability for you to compound in those assets, right, is massive. The replacement cost itself is growing at 8-10% a year, right? And the ability for you to take market share from the customers, where the aspirational India is increased in the last decade by 3-4 times. In the next 5 years, it's expected to increase 3 times. Your air traffic is doubling, etc., etc. So the demand pie is increasing massively. Supply is still constrained. So when you're able to buy into real estate, not because you love real estate, but because the math works, it's a pretty compelling economic argument for us as well. So, I mean, I would say that, look, I think we take a decision based on, whether we manage or whether we buy assets or develop assets on the basis of math ultimately. It's hard to replicate the same strategy that Patu is describing for every company. I think it works when you are at the stage of the journey in terms of growth. And, it doesn't work in many other cases.
Yeah. So see, his strategy will work when you're trying to scale. Is that correct? No?
Absolutely right. See, if I was an owner of a luxury brand, here's the problem in India. People make guesses all the time, but I would reckon, excluding guest houses, there are about 1.5 million rooms in India, maybe 2. I'm going to break this into 2 parts. How many upscale and better rooms and above category rooms are there in India? Best guess.
Luxury is
Would be
35,000
35,000.
branded keys, unbranded ke
Entry
saath,
level 5-star and above.
entry level 5-star and above.
Probably
Mandeep?
three times that.
3
3
lakhs.
5-star and above. Out of 18 lakh rooms in India, I'm taking a midpoint. 5-star and above, there are no way there are 3 lakhs. Absolutely wrong. How many branded 5-star hotels are there in India?
35,000 keys.
Correct. How many unbranded 5-star hotels are there in India?
About 7,000 keys.
20% of the branded. So that's your runway, guys. If you are so I'm answering on behalf of both of us. If you're a luxury operator, and I'm including 5-star there, so deluxe operator, how many more rooms can you brand in India? 20% more? That's your runway? Okay. And beyond that, the runway will be development of assets.
Development of.
So if you are going to be a luxury asset owner with marquee assets, and you've got a very limited runway to increase your managed portfolio, and you have infinite capital or infinite in length, which is what Brookfield has, or even a Blackstone has, or a BlackRock has,
Or a public company has.
or a public company has in the luxury space, I would do exactly what they're doing, and it's a totally smart strategy. Okay. My point is, what happens to the asset light guys? Because you know what's going to happen? You're going to start cannibalizing each other, or you're going to go down. So now let's talk about the iceberg you cannot see. So this is the tip of the iceberg. 99% of the hotels in India have an inventory which is less than 40 rooms. Who's going to manage it, man? I don't want to manage it. Anybody is welcome to manage it. You got to franchise this. So the way I look at this story, and all these underpinnings of growth, levers of growth, airline, Vande Bharat, XYZ, consumption shifts, growth in median income, household income beyond $40,000, which by the way is the magic number for mid-market consumption of branded hotels, aspirational growth, awareness through social media, technology. How's it going to play out? Okay, you got to have a view, and then you got to mitigate the capital you put at risk for that view. Because They're going to risk your ass otherwise. The way I look at it is very simple. Somebody, some 2, 3, 4 players will come along. They'll overplay technology and brand. They'll go to all these 35-room owners. They'll say, we can't manage it. And you cannot. It's not worth your time. Because these hotels earn 3,000 rupees into 35 rooms. Their income is 3 crores a year. Now, if you break down, one day I asked the Marriott head, and I asked Wyndham, Jeff Beluti, I said, how much do you charge for franchise? 11%. How much do you charge for management? Marriott in some cases said 15, 16. So I did a, hawa mein. 1/3 of what I charge is for management, 2/3 is what I charge is for my brand. Therefore, I should monetize my brand, but not the main brand, but a subsidiary brand for these million rooms which are aching to be branded. To me, it's the real 50 to $100 billion opportunity in India, because 1 million rooms will get branded. The question is, who will brand it? Use technology to manage NPS, distribution. Do not be an agent, otherwise you'll be called by every police station and sent to jail. So that's how the system is in India. So you are a sales and marketing distributor. You are the brand provider. You're providing technology. Somehow combine this, create a nice soup, sell it to 1 million rooms, and you'll create a $50 billion company. That's the only way it'll work, okay? And to me, it is a uniquely Indian opportunity. So,
Because of the amount of unbranded rooms.
so the next load of capital for a player like me is not where he will put it or an equivalent. I will go as far down as I can. Basically, I'll go from here to the intestines, and I'll try and look for gold in where.
I was going to come to that question. Now, you've answered it before, but I heard one of your podcasts and you said, look, our generation or your generation, whichever way, were more value seekers, right? Value for money. But the next generation that's coming in is seeking experiences and different experiences. So now we have got this whole rise of, let's say, new boutique hotels or heritage hotels or even offbeat hotels. But these are very small properties with small inventory. Uh, if they try to list, their multiple of EBITDAs will be very low. How do these scale up to do anything meaningful? I mean, yes, they are all operating in one lovely sort of properties doing well, but where is the scale in this? How do you build scale? Is there a REIT type product? And, Ashank, let me ask you first, you manage many REITs. Are these hotels going to offer themselves for rent and therefore you can read them, or how they're going to merge? I mean, one of the ideas he gave was to brand it, but then the experience goes away because it becomes uniform.
I didn't say brand these
franchise
type of products,
Yeah.
by the way.
Said franchise it.
Franchisee. So, but I'm saying if you franchise it, the experience becomes
So
similar.
look, I would say I wouldn't get between standard product and standardized brands versus experiential product. I think the difference really is between commodity real estate and commodity brands versus experiential or differentiated, product, right? Now, we don't want to be, I mean, capital generally doesn't want to be in commodity product, right? And that's because, same hotel, same lobby, same room, same everything. And, you're competing on price then. There's no value proposition for the customer. When there's no value proposition for the customer except for price, when in a downturn, you have no protection,
You have no protection.
right? Versus a boutique hotel or a experiential product, it might be the most stunning property with no system, no distribution, no capabilities, etc., etc. Now that's an opportunity for us, because we own platforms like Leela, to be able to say that, okay, we can come and do something here and turn this around. But that's real operational hard work. If you're simply going to just rebrand the property and say, ki, Arey, maine re-rate kar diya, that's a good story on day 0. By year 3, if you've not improved your ADR, not increased your margins, you've not increased your occupancy, you've not really done any operational uplift,
You are exposed.
you are exposed and your multiple will come back down. So I rather focus on properties which have the bones and the ability for us to be able to create a institutional framework under it, rather than say that, oh, you have a great TripAdvisor or a Make My Trip, Booking.com review. And some of these properties are really fantastic, by the way, right? They are doing things for guest experiences, which, I wish larger chains could actually, get inspired from. But is that scalable? That's not necessarily scalable. And that's where, having the flexibility of, or the entrepreneurship of being able to take it and say, we are going to create some processes around it without killing the magic becomes very important for, these boutique hotels and brands in terms of the future growth. On the REIT side, look, REIT is a great concept, right? And people have talked about it for, many years. I think the first fundamental flaw is you can't compare it to an office REIT.
Because there's no stable income.
And that's not a bad thing. It's an inflation hedge. You're able to reprice the rooms every day. So in an inflationary environment like India, that's a fantastic product. REITs in the US, hotel REITs in the US have been around for 35 years, right? So it's not a bad thing to have an inflationary hedge as a hotel product. The problem is if you're comparing it to an office REIT and saying that, her quarter wahi dividend aega, nahi aega, right? And the capital is also, quite intensive in terms of what a hotel requires versus an office requires. But it's a very interesting product. Today, the problem is that all the hotel companies in India, it's not a problem, it's an opportunity, right? Everybody wants to grow. Fleur will grow also, right? They will develop more hotels. Now, when you're developing more hotels, acquiring more hotels, why do you want a REIT structure that forces you to distribute 90% of your earnings, right? It doesn't make sense. It's a structural mismatch. So I think it's too early for hotels, REITs to be formed. The industry should continue building, continue stabilizing these properties, prove your track record through a cycle, right? And then eventually there will be a time for listing these properties. Yeah.
You can REIT a hotel company if you can create an intermediary lease structure.
Yeah, you can.
That's the only way. Then you have stable income.
100%.
Basically treat it like real estate and somebody else takes the P&L.
The taxable REIT subsidiary that is in the US,
It works like that.
It works exactly like
It
that.
works exactly like
the
that.
The problem is that, again, you won't get scale with that. Today, if you want to create a real REIT, like the office sector has done or the retail sector has done, right, you will get a handful of properties to be able to create one.
I think your point is, see, at your scale, you're talking about what moves the needle. Correct. Now, if I know the time is up. The last point I would add to you is simple, yeah. How is it, you see, small boutique experiential cannot be scaled. Otherwise, why is it the only scale restaurant chains in the world or only scale hotel companies in the world are standardized? Sure, you've got individual entrepreneurial passion and Aman and so on and so forth, but these don't move the needle for a Marriott or a Hilton or an IHG or a Radisson or whoever. The broad point is each is a niche. There is a mass market and there is a niche.
Correct.
And it doesn't make sense. I have argued with Puneet. I know he's not here today. I told him, this Ama thing, I don't understand. Okay, maybe one day you will monetize it. Maybe you are so large that, it's just small kida on the side that you will be able to do it. But I don't understand.
Guys, I think you've finished the extra inning and the
I'll
extra
just,
over.
but I'll just add to that, right? Fully agree with you. Four Seasons started as a boutique hotel operator. Six Senses started as a boutique hotel operator. Aman started as a boutique hotel operator. Leela started as a boutique hotel operator in many ways, right? So I think scale is possible, but let's be honest, right? The muscles required to create a platform is very different than the muscles required to deliver that fantastic guest experience. So those capabilities also have to get married to be able to create a platform out of a boutique concept and eventually scale it up.
We can continue this debate, guys. We've had the good fortune of having two very experienced people and who've actually invested a lot of capital. So please, can we have a big round of applause? As Ashank just put it, guys, it's a winning team, but even winning team needs strategy. There's no one fix for every match. And equally for capital side, there's not one strategy that works for every brand, for every category of hotels. It's a long subject, which we can take offline maybe. Thank you, Patu. Thank you, Ashank, once again for being here and supporting this. And Mandeep for having us on the stage. Thank you very much, Mandeep.